Let me say something that might upset finance YouTube. Some of the most repeated investing advice online is incomplete. Not wrong on purpose, not malicious, but oversimplified. And when you oversimplify money, you can accidentally cost people thousands. If you've ever heard, max your 401k immediately, just buy dividend stocks, always avoid debt, index funds solve everything, cut coffee and you'll be rich, then this video is for you. Because today, I'm breaking down 5 investing rules that almost every finance creator repeats and what you should actually be thinking instead. This isn't about attacking anyone, it's about thinking deeper. Let's start with the biggest one. Rule number 1, max out your 401k as fast as possible. This is probably the most common advice in personal finance. Max your 401k first, tax advantage everything, compound interest is king. And listen, tax-advantaged accounts are powerful. But here's what almost nobody talks about: liquidity. When you put money in a 401k, you can't touch it without penalty. It's locked until retirement. You lose flexibility. And for a 22 to 35-year-old, flexibility is often more valuable than tax optimization. If you want to start a business, want to invest in real estate, might relocate, might pivot careers, then locking every spare dollar away may slow your opportunity growth. What to do instead? 1. Always take the employer match, free money. 2. Split capital between retirement and flexible investing. 3. Build an opportunity fund, not just a retirement fund. Because wealth isn't only built at 65, it's built through leverage and optionality. Rule number 2. Dividend stocks are passive income. This one is huge on YouTube. Build a dividend portfolio, live off cash flow, get paid to own stocks. Sounds amazing, but here's the reality. Dividends are not free money. When a company pays a dividend, the stock price drops by that exact amount. You're not gaining extra value, you're receiving a forced distribution. Also, dividends are taxed. They limit reinvestment flexibility. They can slow growth compared to total return strategies. Now, are dividends bad? No, but framing them as passive income magic is misleading. What actually matters? Total return. Growth plus dividends combined. If a stock grows 10% without dividends and another grows 6% plus 4% dividend, they're the same. Focus on strong companies, low fees, long-term compounding, not just yield. Rule number 3, just buy index funds and you're done. Index funds are one of the best investing inventions ever. Low cost, diversified, historically strong. But here's the nuance. Index funds are market exposure, which means if the market is overvalued, you are fully exposed. If tech is 35% of the index, you are overweight tech whether you realize it or not. Index investing works best when you understand volatility, when you can handle drawdowns, when you're not panic selling. The problem is, most beginners don't understand what they own. So when a crash hits, they sell, which destroys the strategy. What to do instead? 1. Use index funds as core holdings. 2. Add risk management awareness. 3. Know what sectors dominate your ETF. 4. Adjust if necessary. Blind investing isn't investing, it's outsourcing thinking. Rule number 4, avoid all debt. This one sounds safe. Debt is bad, pay everything off, zero debt equals freedom. Consumer debt, yes, dangerous, but strategic debt, different story. The wealthy use debt to buy appreciating assets, leverage real estate, expand businesses. A 3 to 5% mortgage locked long-term during high inflation can actually be a financial advantage. Inflation reduces real debt cost. The issue isn't debt, it's what you use it for, your cash flow stability, and your risk tolerance. Avoiding all debt can sometimes limit wealth building. Misusing debt destroys it. There's a difference. Rule number 5, cut small expenses to get rich. This is the most viral advice. Stop buying coffee, cancel Netflix, don't eat out. And yes, expenses matter. But here's the math.
Cutting $5 a day equals $150 a month. That helps. But increasing income by $1,000 a month changes everything. Most finance content overemphasizes frugality and underemphasizes income growth. Your biggest financial lever is your earning power. Skills, negotiation, side income, business, investing in yourself. Optimization matters, but expansion matters more. Psychology section, retention boost. Here's the deeper issue. Finance YouTube simplifies advice because simple advice spreads. But money isn't one size fits all. Age matters, income matters, goals matter, risk tolerance matters. A 22-year-old software engineer and a 45-year-old parent of 3 should not follow identical investing rules, but online advice treats them the same, and that's the real mistake. What you should actually do: instead of memorizing rules, build frameworks. Ask, what stage am I in? Do I need liquidity or tax efficiency? Is my goal freedom, stability, or aggressive growth? What risk can I emotionally tolerate? Wealth isn't about following slogans, it's about aligning strategy with your life. If you've ever felt confused by financial advice online, you're not crazy. You're just hearing simplified rules designed for mass audiences. The smartest investors don't memorize tips, they think in systems. If you want deeper breakdowns like this, subscribe, because this channel isn't about hype, it's about understanding money at a level most people skip. And that difference? Over 10 to 20 years, it compounds more than any dividend ever could. See you in the next one.